What is good, YouTube? Today, I believe, is going to be day 10 of the beginner's blueprint. Today, we are getting into the second, what is it called, the second quarter, which we're going to be learning all the terms I use from a day-to-day basis when I trade. There's only about 3 or 4 of them that I use. It's really simple. And today, we're going to be learning about fair value gaps, which is in my opinion, the most important one besides liquidity and liquidity sweeps, but that will be in another day or two. However, fair value gaps are a really simple topic to understand, but there's a lot of knowledge to go into them and stuff to understand about them, but it's all relatively simple at the end of the day. So without further ado, let's get right into it. Starting off with, what is a fair value gap? Well, the basic definition of a fair value gap is going to be it's a liquidity void in the market or an imbalance in price action. And then how to spot it, or how do you know what is a fair value gap, is it's a 3 candlestick pattern with no overlapping wicks from the first to third candles. Hold on, let me get this out of here. So, all right, this looks a lot better. So on our left hand side, we have a bullish example, and on our right hand side we have a bearish example. So starting off with the bullish example, right? Bullish example consists of the top of the first wick to the bottom of the third wick, right? So here's the top of the first wick to the bottom of the third wick, and then same thing right here, right? Top of the first wick to the bottom of the third wick. So our fair value gap would look something like this, right? That's it. This is just the fair value gap. Now, why do fair value gaps form in a bullish structure? Well, there's a lack of sell orders, right? Is there any down close candles here indicating that people are selling? No. So what is it doing? It's creating a void in the market, which is going to be these gaps. And what does price do when these gaps are formed? Well, most of the time, price likes to seek these areas, fill all the resting orders inside of them, and then react out of them. Now, we don't react the same way out of every single fair value gap, right? Especially if we have 2 stacked on top of each other. Maybe we want to come down here and touch this one and then go. Before we get into that, though, let's just head on over to our bearish example, right? Our bearish example is going to be from the bottom of the first wick to the top of the third, right? So from the bottom of the first wick to the top of the third. Now notice how they don't overlap, right? It's creating a gap in price action. So there's our bearish example. And here's our second bearish example, right? From the bottom of the first wick to the top of the third. Now, if we have 2 fair value gaps stacked on top of each other, what does that mean? Well, there's a premium and there's a discount in fair value gap, right? So if we're in a long market, our goal is to buy as low as possible and sell at the top, right? And then vice versa for a bearish market. Our goal is to buy at the top and sell as low as possible. Right? You guys with me? All right, cool. So, starting off with this bullish example. If we have 2 stacked on top of each other, this first one is going to be a premium fair value gap. And the second one is going to be a discounted fair value gap. Now, it's the exact same thing on the other side, except just flipped, right? The top would be the discount, since we want to buy at the highest point. And the bottom would be a premium fair value gap, since this one is higher above it, right? So, why do we use fair value gaps? Now, we'll come back to this drawing in a second. Let's just get through this first. Why do we use fair value gaps? Well, fair value gaps are used as a retracement tool to fill orders, right? So exactly what I said. If price is way up here, what are we most likely going to do? We're going to come down, fill these voids in the market, right? Whether it's the premium or the discount, and then we'll react out of them. Fair value gaps are also great for setting conditions to see where price is going to go next, right? So if we are bullish in this scenario, right, we don't want to buy all the way up here, because price will most likely be wanting to go down, fill these orders before continuing higher, right? Because price moves in stair steps like that. So if we're going straight up, we want to wait for a retracement before entering. Now, these fair value gaps can then become our conditions, right? So we can say, all right, once price taps into these fair value gaps, Now I can look for an inversion out of it to enter. Now we'll get into inversion fair value gaps literally in the next video. I'm going to record it right after this one, so we stay like roughly on topic. However, that's what we can use. That's also what we can use fair value gaps for, right? Is our conditions. Now we can use these fair value gap conditions anywhere from like the 5-minute to the 4-hour. I'd say about 85 to 90% of the time, I only use the 5-minute and the 15-minute to set conditions. However, sometimes, like actually today, I had a 4-hour condition with a 4-hour for value gap. If it got inverse, I can anticipate us going lower. And if it got respected, I can anticipate us continuing higher on, right? So the 1-hour and 4-hour get used sometimes, but it's mostly just the 5-minute / 15-minute fair value gaps that I'll use for conditions to see where price wants to go, right? Now, what happens if we come all the way up here and we run through these, right? Then what happens? These then become invalid, creating an inversion. Now, again, we'll get into inversion fair value gaps in the next video. But say we invert these two bullish gaps and then create a bearish fair value gap right here. Now, what is our condition? Well, our condition is now going to be this bearish gap. Okay, so we can say if price retraces up into this bearish gap, and then we see, again, we'll get into this in the next video, but if we see an inversion out of it, then we can go ahead and take short positions, put our stops at these highs right here, right? And then put our take profit either to this sell side liquidity right here or somewhere down here. And it can look like something like this, right? So that's why, or that's how we can use these as conditions. Now we'll get into conditions. I'll make a whole separate video just strictly on conditions later on when we get closer to our strategy. However, we're going to focus on just basic ICT concepts for the next couple of videos. Now, our third point as to why do we use fair value gaps? Well, they're used in continuation models the most, right? So we want to wait for a retrace and see a rejection. Exactly what I was just explaining, right? We want to, if price is way too premium up here, we want to wait for a retrace into either, it doesn't matter which fair value gap, right? However, I just want to let you guys know that if there's two stacked on top of each other, the bottom one for a bullish structure is going to be the discount and the top one is going to be premium, and then vice versa for the bearish, right? The top one would be discounted and the bottom one would be premium. So wait for a retrace into it, and then let's see how price reacts out of it. So what can our reactions be? How do we know if it's a valid setup to enter? Well, either a CISD, a break of structure, which is also a market structure shift, or an inversion, right? Because if we're trending down, right, on the 1 minute, say these are 5/15-minute fair value gaps. If we're trending down and in a down structure on the 1 minute, what if we get a 1-minute break of structure coming out of it with a 1-minute inversion and a 1-minute market structure shift? Well, we can anticipate, okay, we filled these orders in a bullish fair value gap, and we're rejecting it. Why? Because we have a CISD, a break of structure, and an inversion. Okay, cool. Once all those things happen on the lowest time frames, whether it's the 1 to 5 minute, let's go ahead and enter stops at these lows, since they'll be protected since they're inside of a fair value gap. And since we got a CISD, a market structure shift, and a fucking inversion, there should be no reason for price to come down and resweep out this low. This low should be protected. So therefore, our stops can go here. Our entry point can be somewhere relatively in here. And our take profit can be at this buy side liquidity up here, or if there's resting liquidity to the left of us, we can also set it towards that, right? Now, all this is the same thing for the sell model as well, except instead of going up, we're going down. And our last point is unfilled fair value gaps can also be used as a take profit area, right? So, prime example right here. I'm going to use this example right here. So we know price likes to come and retrace into fair value gaps because how does price move? Well, it moves like stair steps, right? We can't go down without retracing up, and vice versa. We can't go up without retracing down. So if we're in a downtrend and we run into, let's just say this is a 4-hour fair value gap, right? 4-hour fair value gap. And price trades into this 4-hour fair value gap. But we still have these 5/15-minute gaps unfilled, right? So say we trade into this fair value gap, we get like a resweep of liquidity right here, and then off the resweep of liquidity, hold on, let me move this fair value gap so you guys can see. And then off the resweep of the liquidity, we get an inversion somewhere in here like this. Well, what can we do from here? even though we're in a sell model, we can long this shit because why? We have a resweep of liquidity. We're tapping into a bullish 4-hour for value gap. So what then can we do? And we get an inversion on the lower time frames. What can we anticipate? Well, we can anticipate for price to do something like this. And retrace into that. And that can be our take profit point, right? Now, we don't give a fuck what price does after it, because what if it just wanted to retrace into these and then continue lower, right? Something like this. Doesn't matter. We're already out the trade, right? Our take profit already hit. We entered off this inversion, stops at these lows, especially with the resweep, possible SMT right here with the resweep lows. And then, again, we'll get into SMTs later on. And we target this. And what does price do? Price comes up, hits it, smacks our take profit, we're out the trade, and then continues lower, right? So that's how you can use take profits, or, that's how you can use fair value gaps as take profits, right? Now, we're going to get into the charts in a second. I just wanted to draw everything out for you guys, make it as simple as possible. What is not a fair value gap? Well, shit like this, right? Let me get these X's off the screen. So you guys can actually see. Okay. And our bullish example right here. Do you guys see 2 wicks that are creating a gap? Is there a gap where this rectangle is? No. Why? Because this wick of the third candle overlaps this wick with the first candle. All the middle candle really is like a spacer between the first and third candles, even with this over here. So what would this be right here? This would be a valid fair value gap, right? Because the first and third wicks do not overlap with each other. But what if we get this? Is this a fair value gap? No. Why? Because here's the top of the first wick to the bottom of the third. Are they overlapping each other? Yes. So, therefore, there is no fair value gap right here, and this is a invalid fair value gap. Let me just re-put that back on the screen, and then we'll go over this other example. You guys can take a picture of this if you guys want. All right, now moving on to the bearish example, exact same thing, right? We have 2 overlapping wicks creating no gap in the market, so therefore this is not a valid fair value gap. What would be a valid fair value gap? Well, if something looked like this, right? From the top of the first wick to the bottom of the third. Now, it can be super small too, even if it's like this. As long as it's the top of the first wick to the bottom of the third, right? Or if we keep moving up, like this is also a fair value gap. Super small, but it's also a gap, right? It doesn't matter the size. It don't matter the size. It's how you use it, right? It's the exact same thing with fair value gaps. It doesn't matter the size of the gap. It's how you fucking use it. So this right here would not be a valid setup. Okay? So that is not a fair value gap. Now, since we went through the premium and the discount, hold on. We're going to go into the charts, and I'm going to show you guys a whole bunch of bearish and bullish fair value gaps, and then hopefully we can find a few ones that maybe got disrespected, so on and so forth, right? So, like I said earlier on today, I had a condition set. Oh my God, get all this shit out the way. I had a condition set this morning, right? What was my condition? Well, it was this 4-hour fair value gap. Price came all the way down here, so at market open, I anticipated if we were to inverse this fair value gap, then maybe we can go to this sell side liquidity right here, or maybe continue farther down here, right? Into these areas of liquidity. Now, what did we end up doing? We ended up tapping into this fair value gap and respecting it, right? What did we get? We got to tap into the 4-hour fair value gap and instantly seen a rejection out of it. Now, what did we create on the way up? Well, we created a fuck ton of bullish fair value gaps, right? We have one right here. We have one right here. And this is all on the 5-minute, right? We also have 15-minute fair value gaps that are created. We have another one right here. We have a small one right here. And finally, we have another one right here before price started to chop around, right? So what did price end up doing? Well, price ended up hitting it and then rejecting it, right? Now, this would not be a valid entry for a fair value gap. Why? Oh, here, let's go to the 15 minutes real quick. I'll make it a different color. We have a 15-minute fair value gap right here. And two more down here, right? We have this one right here. Even though this is a down close candle, right, it's still the top of the first wick to the bottom of the third, because what is the next candles? Up close candles, right? So a good way I like to know whether it's a bullish or bearish fair value gap is what is the middle candle, right? Because say this candle was black. I don't see color, but black in this scenario is a down close candle. So say this was a down close candle, right? This would still be technically a bullish fair value gap. So let me just draw it out real quick, right? Because it can get confusing, and especially if you're really new, I can understand how this is confusing. So say we have a down close candle right here, right? We open right here, close right here. And then the very next candle, oh fuck, we get something like this. We get an up close candle. Let's make it a little bigger. And then the candle after that, we get another down close candle. Now, why would this be a bullish fair value gap? Well, because the middle candle is a bullish structure, right? So what do we have? From the top of the first wick to the bottom of the third. Here's our fair value gap. What can we anticipate price doing? Coming down, tapping into it, and rejecting out of it. And it's the same thing for the sell side. I'll make it right here. Now, if you guys need to pause the video, go ahead and do so. Right? What do we have here? We have an up close candle. Oh, fuck. I actually need to fix this. Hold on. Then we have a big Drake down, right? What kind of fair value gap do we have here, guys? What is our middle candle? Is it an up close candle or is it a down close candle? It's a down close candle, right? So we have a bearish fair value gap, right? From the bottom of the first wick to the top of the third. Even though the other two candles are bullish candles, it doesn't matter. What is the middle candle, right? The middle candle is a down close candle, so therefore this is a down close or a bearish fair value gap. So what can we anticipate price doing? Price close right here. Anticipate price coming up into this imbalance in price and projecting out of it, continuing lower. Now, if we wanted to inverse it, it would look something like this, right? And then a retap back into here, right? Because we'll get into this in the next video, but with inversions, price likes to come down and retap that general area one more time before continuing up. But that's an inversion. That's not a valid respect of the fair value gap, so it would look something like this. Okay, so pretty simple. Let's get back into the charts, and then yeah, that should be it. Fair value gaps aren't that hard to understand, but like I said, there is a decent amount of knowledge to know about it. So back to the 15-minute chart, right? Back to where we were. Anything in gray is the 5-minute fair value gaps, and anything in green is the 15-minute fair value gaps. So if price looks like this, right? If we're leaving a shit ton of fair value gaps and we're severely overbought, I don't want to take the premium ones up here, right? I want to wait for something to push into this giant 15-minute one and hit one of these 3 5 minutes that are inside of this discounted 15-minute. I get there's a last discounted fair value gap right here, but it's not on the 15-minute, but it's not the premium one that's all the way up here, right? So if I was looking to long again, I would want to see price push down into somewhere in here and even hit equilibrium. Again, we'll go over equilibrium in another video, but essentially equilibrium is just the 50% mark of the up or down, the down leg, right? So here we have an up leg from this low to this high up here. What is the halfway mark? This mark right here. And what is it also next to? Well, it's inside of the discounted 15 and it's right at the edge of a discounted 5-minute. So what that means is that would build higher conviction, right? If we seen price here, let's just do this. If we seen price come all the way down into here, into these fair value gaps, right? Now we would have inversed these two, but it doesn't matter because we're coming down into these ones anyway. If we have stacked fair value gaps, we invert the top one. It doesn't matter if there's another one below it, right? We need to invert all of them to have a valid inversion. But again, we'll get into that next video. So we come down and tap into this discounted gap. Now what can we look for right here? Well, we can look for a reaction. Since why? We hit equilibrium, we hit a discounted 15-minute, and we also hit multiple discounted 5 minutes. Boom. So what can we look for? We can look for a reaction out of it. If we're not getting a reaction out of it, what else do we have below us? Well, we still have this fair value gap, right? But if we're bullish, chances are if we come all the way down here, we're most likely just going to retrace up into maybe a bearish fair value gap that gets created and then continue lower, right? Because if we're bullish, we're going to want to stay in the general like 50% area. We're not going to want to retrace, especially for this bullish, we're not going to want to retrace all the way back down in here to these ones. Now, how do I know that? It's just screen time from me day trading for the last 2 years. I don't expect new traders to know that. But yeah, that's all essentially fair value gaps are, right? They're a imbalance in price where price seeks to retrace into, and then from there you can look for reactions out of it in order to enter. Now, if you guys have any questions, please leave them in the comments. Your guys' homework is to spot. Here, I'll show you guys an inversion right here. Right. So we hit this 4-hour fair value gap. What do we get? We have multiple 5-minute inversions. So here's one. There's another fair value gap. And here's the last one, right? So this candle, what did this candle do right here? I just want to go over this real quick with you guys, just very briefly, because we'll get into this next video. So we inverse this fair value gap. Okay, cool. So this one's no longer relevant, but we don't expect price to fully flip to the upside yet. Why? Because it still has 2 more barriers to get through, right? We still have this bearish one and this bearish one. Now, we want to see how price reacts off of these. We can use these as our conditions, right? So what happens next? The next candle just absolutely Drake fucking meat right through both of them. Now we can anticipate, okay, price wants to go higher. Once we invert all the bearish gaps, what do we create? We create a bullish gap. Now price was extremely bullish today, so it didn't end up retracing into here. But most of the time, we'll get a retrace, something like this, and then we'll continue higher, right? And let's just see what price ended up doing for the sake of today's video. Well, yeah, it can Drake continue to slap his fucking dick across my screen. So that will be all for today. Your guys' homework is to spot 5 bullish gaps, 5 bearish gaps, and then go go and look for premium and discounted for value gaps going both ways, right? So in this leg right here, in this bullish leg, what do we have? We have 1. We have 2. So what would this one be? This one would be our premium. And this one would be our discount. That's what it would look like for our bullish leg. Now, for our bearish leg, what do we have? Well, we have one right here. We have one right here. We have one right here. So with 3 stacked on top of each other, what do we have? Well, we have the most discounted one. And we have this middle one, which is also discounted, right? Because it's not the premium one. And where would our premium one be for a bearish example? The one all the way at the bottom, right? They're same shit, just flipped around, right? Same, but different. All right. So with that being said, that will be all for today. Your homework: 5 bullish, 5 bearish examples. Go ahead, spot them, or you guys can do 10. I would like for you guys to do 10. And then go ahead and spot 3 different examples of premium versus discounted bullish, and 3 different examples with premium and discounted bearish fair value gaps. Okay, so 16 total things you guys should be looking for today, and then go ahead and just review your notes, shit like that, especially if you guys don't know what fair value gaps are, and that'll be it. All right, so y'all boys have a great night. I'm gonna record the inversion fair value gap video literally right now, and that will be day 11. So you guys have a great night. I will catch y'all boys tomorrow.